If you're looking to make money in real estate, I'm going to share 6 different ways you can make money. Welcome back to Money Mondays, where we release new content every Monday. We release new videos to share at people and learn from our journey and kind of the mistakes and things that we've done to help give investors confidence. But if you're not looking to do it, we're happy to help invest with you. At Disrupt Equity, we've done over $700 million in acquisitions. We'll cross $1 billion this year and done over 5,000 units. We've learned a lot of things in our journey, and we continue to learn things new every day. We've had over 1,000 investors invest with Disrupt over the years, and we're looking to continue to bring on new investors and help beat the market in better returns for those investors. In this video, I'm going to go over 6 different strategies where you can make money in real estate. Real estate is all about diversification, and that includes the ways you make money. What I love about real estate is it has several different pillars that help you ensure success of the deal. And so go ahead and grab a paper and pencil, and we're going to dive into these 6 topics. First, we're going to talk about market appreciation. That's the one we all know about. Next up, we're going to talk about value add. What does that mean, and why does that impact return? Third, we're going to talk about cash flow. I'm a big numbers guy. I like cash flow, and that's a very powerful one. Fourth, we're going to talk about amortization, right? What does that do to my returns and why? Fifth, we're going to talk about tax advantages and how that helps me. And last but not least, we're going to talk about financing and why, if you know what you're doing with financing, you can also help produce cash. The first one we're going to talk about is market appreciation. This is the one most people are familiar with, especially for those of you on the West Coast, right? You may bought a house in LA for $500,000 and 6 years later, it may be worth $1 million. Now with commercial real estate, we don't bet on that kind of growth, but over time, historically, right, real estate does appreciate. Now you're not going to get 50% appreciation in 2-3 years, but historically, commercial real estate, you're getting 2 to 3% rent growth over the time and 2 to 3% appreciation. Now that's really, really powerful. Why? Well, valuations are tied to income. If rent is growing, your valuation is going up. And the thing that we like to say is basically, if you can hold on to the deal long enough, that value continues to grow. So again, appreciation is just one of the ways to build cash in real estate, because again, that property gets more valued, and that allows you to do other things later on in terms of a refi, in terms of, restructuring the deal to help pull cash out of the deal. And another thing to think about, right? As your property starts to appreciate over time, the delta between how much debt and how much equity you have in the deal starts to grow. And as that basically, that spread continues to increase, well, guess what? Start to get more positive cash flow, because presumably, right, you're having more income coming in, and a smaller percentages of that is going to service that debt. And that's why we like to say time in the deal is better than timing the deal. Next up, value add, right? We all know that commercial real estate is valued based on cap rates. What's a cap rate? We've done a previous video, go check it out. But in short, cap rate is really the way to look at commercial real estate and value other deals within the same market. What it ultimately means is if I bought a property cash, meaning I remove debt from the equation, how much returns would I get on my cash investment if I did nothing better or worse than the previous seller? Meaning I didn't improve it, I didn't change anything, I just operated the exact same. That's what a cap rate is. So now the equation for cap rate is what? It's cap rate equals NOI over value. So now, if I do things to improve the NOI, that actually improves the value. Pretty simple equation, give it some thought, but again, it's the fundamental of how commercial real estate gets valued. And so what do? Whenever we go look for a property to buy, we look for ways to add value, whether that's improving the interiors and getting a higher rent. It could be as simple as installing covered parking and getting an extra set of rent for that covered parking. Or we could do other things, right? Sometimes we do something as simple as just painting a reserved spot and selling those. As an investor, you're constantly looking for ways to improve a property, but what does that allow me to do? That allows me to buy a property day one at a certain cap, and over time, as I make those improvements, that cap rate gets better. And what that fundamentally means is I'm getting more cash flow. Right? If I bought a property day one and let's say all it can do is cover the debt that it has on it, but then in a year from now, I've increased the revenue 25%, all of that starts to become positive cash flow. And that's really the thesis and the basis of how to quickly generate income from real estate. It's finding things that the previous owner neglected, didn't have the cash to do, and ways to drive NOI that allows you to step in, buy a property, and then turn it into an income producing property. And by doing the value add, right, what does that do? That allows us to do what we call forced appreciation. We just talked about kind of market appreciation, but forced appreciation is the other kind of unsung hero that allows you to essentially force a value to go up, right? And so these things are very related. Very powerful. All right, next up is cash flow. We just talked about value add. What was the point of value add? It's injecting capital to make property better to generate more cash. Now, cash flow is the thesis of real estate investing, right? It is the way you take money out of an investment. Now, whenever you structure it with debt, right, maybe you're going in 70% debt, 30% of equity. Well, cash flow is really what money do I have left over after I pay all expense. And so again, if the property is essentially breaking even, anything you do from a value add perspective starts to yield and give you that cash flow. We are cash flow investors. We look for opportunities that we can buy, do our value add, and basically start to peel off positive cash flow. And that's related to another term we've previously talked about, cash on cash. Cash on cash is the number that matters in the day-to-day operations. That's really what is the actual return being given, not on just what we bought the property for, but actually on the equity we brought, because equity is our cost of capital. Debt is considered just an expense whenever you look at it from a P&L perspective. But equity is the money that made the investment. That's our opportunity cost, and we're looking at how much cash can we give back each year to equity, whether it's our equity or our investor. So again, to improve cash flow, right, what can you do? It's the things that we talked about from a value add perspective. Looking for ways to drive NOI and be improving rents. It could be reducing expenses. It could be adding in new amenities that you charge for, etc. So give that thought, because every dollar goes at cash. Next up is amortization. For those of you that don't know what amortization is, right, it's really the process of what your loan looks like and how it breaks down and burns down over time. Typically, whenever we buy commercial real estate, we're buying deals that are 30-year amortizations, but are 10-year notes. What does that mean? That means that in 10 years, we have to return the loan in full, but during that 10 years, the loan is broken down into as if it was going to be 30 years of payments. Now, why is that powerful? Because if you think about whenever you buy a house, right, if you bought the house and held it for 30 years, you own that house free and clear at the end of the 30 years. There is no debt on it. It's actually building equity for you in the deal. Remember what I mentioned about equity and loan? Well, over time, right, your equity starts to increase as your loan starts to decrease. And this difference right here is the value that you're looking for. Now, we also talked about market appreciation. So now as the market appreciates, that spread continues to grow as well. And so again, real estate is powerful because all of these things start to stack up and line up. And so again, amortization is one of those unsung heroes that doesn't get talked about much, but it is a very powerful thing to help improve your. And one thing to add, right? You have to understand the loan that you're getting into, right? Sometimes there's things that are called interest-only loans. That is not going to help your amortization or burn down the note over time because you're only paying interest payment. And so again, understand the loan that you're doing, understand the impact, but these can be very powerful things. Next up is tax advantages. Now, again, this is one that's not immediate to people, right? Because you're not getting cash flow, but you are getting it on the back end. We love to invest in real estate because we get some really strong tax advantage. And the big one really is about depreciation. Whenever we buy commercial real estate, we do what's called a cost segregation study. That allows us to piecemeal the property into its sub-pieces and take a lot more depreciation year one. Now, talk to your CPA, right? Talk to your expert. But for certain people, if you structure it the right way, you're able to get significant amount of losses that you can then apply towards income and reduce your tax burden. This isn't really talked about whenever we talk about returns to investors because it varies by investor, but this is sometimes the main reason a person invests. We have many investors that say, hey, I'm only investing because I'm looking for depreciation. Because again, if I just made $100,000 in 1 year, guess what? I'm probably gonna pay $30,000 in taxes. And so I look for ways, how do I make that $30,000 go to zero? And tax and depreciation is a huge piece of it. And sometimes this can be significantly better returns than the deal itself. So again, that's why some investors look for safest deals, safest areas. They care less about the immediate returns and they care more about the tax benefits that they're gonna get. So for an example, right, whenever we have an investor that invests with us, let's say they put in $100,000. Well, typically year one, we may give them a K-1, which is the tax paperwork that you get, that says this person's income was negative $50,000 from that investment. Now that person is able to take a $50,000 paper loss and apply that to their situation or their CPA and potentially save paying tax $50,000, which can be very powerful. And last but not least, the one I want to talk about is financing strategies. If you're smart about your debt, you can really start to cash, right? Now think about all of the things we talked about so far, from market appreciation to value add to cash flow. These things start to compound. And so if you buy the right deal, work on it for 2-3 years, and then you do a big refi, right? You can pull real cash out. We like to do deals where basically in 4 to 5 years, we can do what's called 100% cash out, where we can basically go in, do the improvements, and then in that year 4 or 5 mark, we pull 100% of our investor money out. That allows us to own the deal without any money into it. We essentially are getting infinite returns because we have no money in it, right? That's really, really powerful. And that becomes powerful because it's about time in the deal. Again, I said this earlier, time in the deal is better than timing the deal. It's basically where if I can be in the deal long enough, given all these other factors, it becomes really, really powerful because then I can start to pull big, significant chunks of money out. I met someone about a year ago who him and his dad have been doing real estate for 40 years. Their entire business model is about buying deals that they just hold on to forever. Every couple of years, as these things start to compound, they pull big chunks of money out. And they had one deal where they had done 6 refis out. The guy literally said, we've owned this deal free and clear, and we've pulled 100% of our money out of it 6 times. Right? What is the return on that? Well, it's already well past infinity. It's multiple infinities. And those are the kind of things where if you're savvy, you understand the debt, you understand how all these pieces play, it can be very, very powerful. And it's really what I like to say, the bow on real estate investing, right? It ties it all together into something super powerful that allows you to pull real significant amounts. That's why the phrase that he told me that's kind of stuck with me since then is basically those that are rich sell, those that are wealthy hold. Right? Because if you can continue to hold the deal, you will build real wealth over time. So let's recap, right? All of these 6 strategies, it's not about one or the other, right? It's about playing to all of them at the same time, and that continues to reduce risk from the deal and gives you multiple opportunities to both generate cash and get to a performing deal or something that's going to generate real wealth over time. So again, give it some thought. These things all compound, and it's really the fundamentals or the pillars of real estate. This is where the first time I kind of learned about all of these, it really opened my eyes to the power of real estate investing. I come from tech. I know a lot of people that think that they're the smartest people in the room. They go search Google, real estate versus stock market, and what do they see? They see that real estate appreciates 2 to 3% a year, like I mentioned. And that's their gauge. They say, well, real estate only grows 2 to 3% a year. Stock market averages 10, 11%, right? Take your number. And guess what? Real estate must suck. No, that's not true. Power of real estate is about compounding all 6 of these things into something that's going to yield real general wealth for you. So in a nutshell, that's really the 6 ways that we like to make money in real estate. Remember, real estate investing is about putting together a business plan, doing your research, understanding the impact of all of these things. But if you do that homework up front and then you go buy the right deal, execute the right business plan, you have a lot of ways to succeed. And so again, give thought to it. Go in there and understand what's going on and how these things impact what my investment's going to be. And then go and rinse and repeat. Do the first one. Get it stabilized. Leave it alone where it's going to operate by itself. Go do the next one. These things start to stagger, and that's the last piece that really starts to build and snowball wealth over time. If you like this video, go ahead and like, share it with a friend, and let us know your feedback and what you liked. If you have topics for future ones, go ahead and leave a comment below. We'd love to hear what topics people want to go out and have us deep dive into. Thank you, and see you next time.